There is a substantial risk of loss associated with trading forex, binary options, stocks, or equities, collectively, asset classes. Only risk capital should be used for trading. Trading in any asset classes is not appropriate for everyone. Past performance is not necessarily indicative of future results. No representation is being made that investors will make profits, or will not sustain losses. Before trading in any asset classes, investors should consult with their professional broker, financial advisor, or financial consultant to determine whether trading asset classes is appropriate. Investors who trade in any asset classes should only do so if the capital used for this purpose represents funds that an investor can afford to lose without adversely impacting the investor's lifestyle. No trading strategy or methodology is without risk of loss. No trading strategy is risk-free, and no trading strategy can guarantee profits or freedom from losses. Investors risk losing the cost to execute any transaction, including associated commissions or fees. You should carefully consider whether trading in any asset class is appropriate for you in light of your investment experience and financial resources. Any trading decisions you make are solely your responsibility and at your own risk. None of the statements or materials in the Auvoria Prime chat rooms constitute a solicitation or recommendation to buy or sell.
So welcome all Auvorians to 2023. Today's the 7th of January. My name is Steve Vetterl. I am the firm's chief market analyst. Try and act in a hopefully an exemplary role. But in addition to that, I try to act in a risk manager role. So what we're going to do, just kick off the new year, and everybody's always joking around, at least in our group, about resolutions and this and that. What are you going to do to start the year off? So I thought, in terms of just risk management, best way to start the year off investing wise is to go through what I do, which has slightly changed. I kind of augmented it a bit in terms of daily research. Okay, so I'm going to go through that today in addition to talking about charts and all kinds of other fun stuff. But let's start off with, just real quickly, making the screen larger. So with my research, I typically want to check out, I don't really do a lot of deep research in this, but you kind of want to check out like the headlines, how was the response to any particular policymaker or central bank to news that was released, right? So with this, I'm not sure if you guys can see this URL up here, but it's really just kind of a URL that has links to all of the global markets. So these are the list of global news. I wouldn't go through each one of these, obviously, but you'll have the groups of your favorites. Some certainly rise to the cream of the crop. Probably stay away from CNN unless you love those guys. But the cool thing is this is a list of all the watchdogs out there. So if you want to fact check something or something that's big in the news. And then there's the financial news, obviously. I would stay away from most of the journalists out there's opinions on a particular stock, right? If it's a journalist that's speaking about it, just disregard that. If they're interviewing somebody big, especially the favorites that I follow on Twitter, and I've talked extensively about this, but at FXES Trader is my handle on Twitter. Everybody that I follow, for the most part, is very, very collaborative, very generous with their research. And the vast majority of the people in the investment arena, both research traders, hedge fund managers, analysts that I follow, these folks are far smarter than I. So I'd rather just collect sort of a consensus of everything that's going on versus just, and look, I get it, part of risk management is formulate your own opinion, right? But your opinion can slightly be changed or augmented by a deeper or better piece of research that's far greater than something you may have the time to do, right? So here's the financial portals. So this is like a super good link system to everything that's out there. Central bank notices. So this is the Fed brief calendar I'll often refer to right here. Market readings, so forth. Trader's Corner, it's actually pretty good stuff. It covers everything. It covers currencies, you name it, commodities, futures, equities, options, so forth. This is just an absolutely exhaustive link schedule. So if you're confused about an economic calendar, something's not right. It's very rare in my entire life that Forex Factory's ever gotten something wrong, that you can use this as sort of like your checks and balance. Sentiment and indicators, I'd probably stay away from this, other than anything that Sentiment Trader posts, which he's a highly recommended follow. Or the COT reports, or as far as just the settlement reports on each of the respective indexes websites, I'd probably stay away from most of the rest of this stuff. But just good for news. Trading portals. If you want to dive obviously into sector work, getting into anything deeper outside of this, as many of you know, I use IBD, Investors Business Daily. It is one of the best out there, some of the best screeners out there. I'm not going to get into that. I've done an entire segment on IBD in the past, but that just kind of gives you a flavor for what's going on. Usually what I'll do is I'll go to the home page, and this sometimes can help guide me in my, but honestly, anything that is inflation related, that is spoken about by somebody that's very important, right? That's a list of probably maybe 5 to 10 people, including Jerome Powell, right? So, and other central bankers in Europe. So the key thing really there is you focus mostly on stuff that's truly going to be driving price movement. So right now, obviously, inflation is first and forefront. There are always times in the past when other things take over, either geo events, wars, transition out of, crypto at the end. But for approximately the last year, it's been all inflation, as inflation has been unfortunately rearing its ugly head, and much more so predominant in certain types of sectors. So, so I'll go through headlines. I'll see what's going on as far as the scoreboard, right? I have my own charts, but I kind of want to know what the performance has been in different stuff or areas that I'm following, right? You don't have to get into all this, obviously, but then here's the futures going on, the economy. There's a section in here a little further down about what's going on with metals, highs and lows. If you're an ETF person, this is actually pretty cool because it shows you what's going on and all high volume gainers and losers, sort of like what's what and what not. Just keep in mind the rebalancing quarterly of ETFs will sometimes put these guys in these columns, which really the only reason they're in the columns is from a rebalancing standpoint. So we'll put as much equity into that one. But the other thing that's cool is you can gauge a lot of what's going on as far as performance and everything, as far as the nighttime watches, composites, and so forth. It's probably a bit much for a lot of people, but as anybody that's running just larger chunks of money, either personally or professionally, I think it's a good habit to get into, just ripping through this. You could probably take, 20, 25 minutes and burn through most of this stuff, but that's between the hedges. I'll go into the daily charts as I've been showing. Obviously it's been the holidays, so I'm not putting really as much price action discussion into any of this stuff as I have been sort of out of the game for the last 2 weeks. But as we start to develop into the beginning of Q1 trading in 23, we're going to want to begin to see some themes developing, right? So we have the theme of lower equities, other than last Friday, which was probably just a short barbecue. This is one of those Q clearing days, but we did have a good jobs report. So, the problem with that, from at least the perspective I would think of big equity only or mostly equity only mutual funds or investment pools out there, they don't want to see a good jobs report. Why? Because a good jobs report just means people have more money to spend. They're willing to pay these inflated prices, which is more likely going to do what? It's going to push prices up more. It's just not good, right? And as I've joked often in many of these discussions over the last quarter, we're just not seeing enough pain out there, right? I've given tons of examples where pain's not out there. So certainly it slowed down the borrowing, no question about that. But it hasn't trickled down into the common man, right? They've just adjusted. Maybe they're not out buying cars or houses. They're out buying other stuff, right? So at some point, the only way inflation is going to come down is if pain truly hits the common man, right? It's not going to hit the upper crust, so forget about that. But in terms of just the general middle class of this country, we have to start to see the pain really set in, or at least a chunk of earnings in these areas, which has already been repriced in the market, obviously, over equities decline over 20% in the broad market last year, at least here domestically in the U.S. We got to see it. So, what can somebody sort of take away from that? And, the members of the Federal Reserve's Open Market Committee, which is the FOMC committee, have voiced concerns that, investor willingness essentially to plow back in equities, that even a hint that rate hikes are over is making their job a lot tougher. So anytime these rallies take place, like we saw a chunk of Q4, right? Remember I joked about, we wouldn't be standing in the way of the Santa Claus rally, which they absolutely pulled the rug out over the last week. I should say the last 2 weeks. Hell, even the whole month of December if you want to expand it out, right? But the Open Market Committee has just been talking a lot about that. And, the jobs numbers, I just think, add to that. So this is really based on their minutes from last month. But, as a country, after being treated to essentially the longest and lowest interest rate environment in modern financial history, right? Investors became more addicted to cheap money. I mean, it's no surprise. These stories are everywhere. So the S&P 500 expanded by more than 2,500%, right? Remember, the market hit 666 on the S&P in March of 2009 and ripped 2,500% all the way up to 2021. So as the Fed kept rates as close to zero as mathematically possible, money became cheap. And once the Fed started jacking up rates last year, it's a bad case of withdrawal. And, the markets actually shrunk, by a whole bunch. So in the fight really against rising prices, Chairman Powell and the whole Federal Reserve team have been aggressive with rate hikes. But, while the rising cost of money has blown up equity pricing, IPO markets, SPACs, which are usually just a special purpose acquisition, it's usually crap. I typically don't invest in anything that says SPAC on it, by the way. Don't get railroaded into that. But, traders still get kind of tingly, as we saw, for most of the fourth quarter, when it appears that the Fed's going to pivot. Or if they're taking their foot off interest rates, everybody piles back in equities again. Again, not enough pain, right? So these are the things that I want to begin to see the cracks build in the fissure, or however you want to joke about that, right? It really just complicates things for central bankers who are looking at, all kinds of different data, and they're now concerned that, they'll have to contend with an over-exuberant equity market and or bond trading desks pushing prices higher before the Fed has fully got its hands around inflation, right? So Wall Street uses a variety of things to gauge whether inflation stands. So does the Fed. As I may have talked about in the past, the Fed remains quite committed to the core personal consumption expenditures price index, or what's called the core CPI. So, and that currently stands at 4.7%. It's projected to fall to 3.5% by the end of next year. Possibly 2 by the beginning of 24. That all sounds great, but, surging stock and or bond markets might throw a wrench in that process. So essentially, to combat a potential Wall Street hashing of the inflationary mellow, Powell's going to have to make future rate hikes more dramatic, making mortgages and other loans significantly more expensive for regular Americans. So keep in mind, guys, the whole underlying theme of this, that most of the smartest people on Twitter I follow and all their bitchings and moanings around this is that's how a recession starts. So no central banker, and for that matter, no real policymaker anywhere on either side of whatever aisle, is ever going to tell you that they're trying to essentially get us into a recession to curb inflation. But it's kind of what's going on. Whether you choose to believe it or not, it's up to you. The key really is that how do you make decisions on investment portfolios based on this? Well, as all first down clients and most of the Auvorians that follow me and or Everybody else that follows me out there in podcast land knows that we've been mostly in cash and client accounts. And I don't think we have one client that's got more than about a 25% equity allocation, regardless of their time frame, right? Because this could get another 20% ugly in the equity markets easily in a lot of global equity, especially the developed markets, right? I talk mostly about developed markets because it's much more of a dice roll in emerging markets, right? You know, half the BRIC countries, I don't even believe in it anymore, especially China. So I invest nothing there. But, you know, I don't know. I mean, not everyone's worried. So, you know, Pal's nightmare, essentially the stuff dreams are made of for anyone on Wall Street's, you know, playing along with the Fed's tenor of a more than cautious forward guidance. But, you know, there's still lots of room for things to essentially go awry. So let's get into the charts here. I think I've been rambling long enough. I think that there's, unfortunately, a increasingly greater degree of need for a backstory for everything else to sort of make sense, right? Here's the other thing, just totally surprises the crap out of me. Let me just a falseness here. Things are disappearing. But take a look at the Euro Stocks 50 chart. It even shows up. This is kind of crazy. Because this chart, this is the long-term, you know, we're looking at weekly chart here of the top 50 stocks in Europe. This is companies like, you know, BMW, BASF, stuff like that, right? They're not that far off the high. And this is the thing that just really strikes me as odd. I mean, what the hell are they seeing that they're not seeing in the U.S., right? I mean, it's like totally broken from what's going on in the S&P. This is an S&P chart, which is not the same situation, right? This is a bear market chart, right? Here's the pandemic right here, and then we ripped, obviously, on complete Fed stimulus and the money falling out of helicopters thing I like to joke about. You know, but here's where, you know, things started to get ugly. We knew inflation was starting to ramp. You know, I was out there sounding the freaking horns on the rooftops that we're getting out of equities at this point, and you know, it's paid off handsomely in the form of a lot less risk and performance loss, right? But at the same time, you know, you can't take too many victory laps from the standpoint of, you know, any kind of longer term invested, because you really want to try and, you know, find a bottom, right? And, you know, essentially, if you wonder why we had such a ridiculous reaction off of this low, look where this was essentially what's called a flashpoint. It's where we just had an absolute burst into a newer paradigm or an upper zone, if you will, by other time frame players. So they blew us out in late 20 into a much higher level. And this is really the line of, I don't know, whatever, the line of demarcation right now. It's actually a zone that goes from like 3,400 on the S&P all the way up to about 3,500. This is basically a zone of support. And you want this to hold. Or really could get ugly. So have you heard of anybody that's out there prognosticating S&P 2,500? Why is that the case? All I gotta do is look at the chart. It's that simple. Head it back down to that previous zone. Now, unfortunately, long-term type macro stuff, these are zones. It's not a price point. It's an area. And that's the key thing you want to always keep in mind, even though I talk a lot about equities. Most of the way that these charts and everything I talk about completely is for everything, including currencies. So, say look at the news next week. The only thing that matters to me is CPI, and obviously the Fed's not looking as much at the, you know, month over month to pay more attention to year over year. This core CPI, right? What I just talked about here. You can read more about this stuff if you guys care to do any scrolling, but essentially the core CPI, this is really in tandem with the other indicator that I'd mentioned. These are the two things the Fed look at, so you want to focus on these next week. Keep in mind these times are Eastern time as we're here in Florida. So, trading around this stuff, good luck to you. I'm not going to do it. I don't. I'll usually let a hopefully a theme play out or some sort of trend begin. If this is a dramatically lower number, I think that'll probably shock the market next week. But I just don't see how it is, right? Jobs numbers are strong. I think a lot of people have burned through whatever amount of money or given up on sucking the government dry, at least here in the U.S., and they're starting to go out and get jobs now. All that's going to do is just fuel demand. So we got Powell speaking Tuesday. What he's going to say is probably participant. Central Bank Independence and Mandate of all the risk at the Risk Banks International Symposium. So it's going to be a fairly canned presentation. That's going to carry as much weight, but this is the big one here next week. It's really the only thing you need to be alerting on. All right, so let's go to the futures markets. Let's go down to currencies. That lumber price, by the way, guys, right? All right, so a little bit of a rally in bonds. Keep in mind we're looking at double checking weekly charts, right? So longer term stuff. Looking at the bond markets here, a little bit of a rally longer term for most of Q2. Sort of the pain stopped, especially in the 10-year, right? So if I was looking for mortgages, this is one you want to pay attention to. And, its movements are perfectly correlated with the pricing of, what was a 3.25%, 3.5% mortgage going on right up to, 6.25%, 6.5%. But I think the interesting thing that can be armchair quarterback here in January of 23, looking back at the U.S. dollars movement, is that, again, this is a weekly chart. Each one of these candles represents a single week. This was essentially just a massive top. And since then, it's been a grind lower of over $10. Okay. So until that changes, that seems to be the case. Now, if things go just bananas next week and the U.S. dollar starts rallying, I guess I wouldn't be surprised, but it looks like we still have some more work to do in this 103 zone, which seems to be the bottom. Everything else in majors is going up, exception the Canadian dollar. It's kind of surprising. But I talked ad nauseum why that's the case. There's other factors I probably am not considering. Take that one at your own grain of salt. On a research front, chart you guys are looking at is tradingview.com. For all of you who do not know who this group is, they are just absolutely murdering it. These guys are killing it, putting out a platform, even in a Pro Plus version, which is the difference between most of these platforms is just in how many indicators you can have on the chart. So with Pro Plus, you can have up to 10 indicators on the chart. I prefer to have the indicators that are the following. And I have them listed up here so you can just see them. But this is a fancy triple moving average, okay? You can get all cute with the 33s and the 11 lines, and I know all those stories, but these are the main ones I prefer to look at as far as moving averages. As far as Bollinger Bands, these are nothing more than just a measurement via some sort of standard deviation of volatility and a potential zone that may be magnetic or rejected from, right? Highs and lows. These are these outer bands that are green. The VRP, what I just prefer to call market profile lines, are in here. I don't have a lot of this stuff turned off and on, but you can turn it on, and then you can have the settings. This is just more volatile stuff, but I prefer to have the value area highs and the value area lows. You can mark them off. They will show up on the chart as these blue lines up here, higher or lower. You can hide all this stuff. These lines represent a zone of where most of the aggregated volume takes place, and you can use these on almost anything. Okay, I don't know that I'd use this on an options chart, but I certainly want to use it on the underlying equity index or ETF that corresponds to it. Outside of that, I just use it for analysis, big picture stuff. So if I'm looking at the DXY, this is not going to apply, right? Because there's no volume on this. But if you take this and you want it to correspond to, let's just say the euro, right? There you go. Provided, this has been my biggest complaint, provided that you trust the data coming into your charting system is the extent of how much you put into this. If you have a really good charting system, like TradingView, and you trust the aggregated volume data, because this is always much more of a ambiguity type issue for me in Forex, because you're getting volume reported from FXCM in this case. You have no idea how they aggregate data, right? That's the problem I've always had with this. So if you look at the futures markets, right, you go to the CME, let's say you're trading E-mini, which you guys can see here. The vast majority of this volume may not have been traded on exchange, but it is reported. So you know that if you're getting a certain amount of aggregated volume data coming in, sure, you need to sometimes scrub the data, I understand that. But in terms of just general, it's dependable data. Like I would bank $1 million trades on the quality of that data, right? Whereas something in the Forex markets, I just don't have that kind of, right? And this truly is a risk discussion, and I've probably spent way too much time on this in the past, but it just irks me, right? I guess maybe subconsciously I hope that some sort of data aggregator will be, I know I have a bunch of people that run Ninja Traders data feeds and stuff like that from DTNIQ that actually watch this podcast I know of, that'll just get so sick of me talking about it. I'll put out a video I can play for everybody to sort of calm down the crazy in this discussion. But I base very, very heavily in market profile on what I'm going to do on not only obviously the setups of the profile and these zones that they build, and those are very fluid and they're always changing and all that, but I base a lot of it on the quality of the data that's coming into the system. So over the holiday, I got an email saying, well, Steve, well, then what would be your perfect scenario? It would be Linsoft's IRT software on the ES with the DTNIQ feed. That is my answer, which I run on another system. So let's take a look at the DXY. Daily chart. I don't know if you guys have noticed I've moved a bunch of my stuff around. I've also, for what it's worth, these guys have been bugging me for a couple of months. I installed this Lux Algo. Supposedly it's got really good signals on it, so I'm going to try it out. I haven't checked it out yet. It's what's called an invite-only script. You have to pay for this stuff, but they gave me these scripts. You guys have just a huge following on TradingView, and I really haven't spent much time over the last year getting into any of this stuff, but let's just say they talked me into it the other day. So I'll check these out. I can be able to show these and just have, an additional tool that can help you with indicators, right? I mean, if you have the best indicators in the world and you got a good solid brain and risk management skills, and you know how to position size correctly on these trades, you should be a good trader, right? Theoretically. Right, so let's take a look at the US Euro connection. So, it's not just since the top of the dollar here where we're down just a little bit below parity. We've rallied all the way back up to a much bigger zone. You really got to look at weekly charts just to see where the big, where all the meat is. So interesting that we're looking at 2020 to now. So we're looking at 3 full years of trading and volume data. I guess I could probably back this up to include less. Not much changing. See, when I change that, it's not changing the data that's at. Look at the value area low is this. This has been a magnet. See how it came down and came up against it again? So the more volume data you have aggregated, the more you get to see where all the trades take place in terms of the execution volume, right? The biggest volume of all is this point of control line, okay? I don't have these labeled because they just hog everything, but I can label these prices on the chart. Try not to do that because it gets people thinking more of a number web versus just a zone, right? So this whole 118 area is where over the last 3 years, most of the trades have been executed. The bottom zone, this is a 70% range of volume, by the way. It's right here. So this is a real magnet, but probably could be, depending on the news that releases, it probably could definitely be there's a chance, let's just say that. Let's take a Dumb and Dumber reference. So you're saying there's a chance. There's a chance that we will bounce off this level. This level also corresponds with a long-term indicator. See this yellow, orange right here? This is part of the squeeze zone indicators. So right now you're seeing many factors come together to form what's called confluence. So confluence is very powerful, probably one of the more powerful topics in technical analysis because it's just nothing more than where a whole bunch of things show up at the same time. You know, and honestly, if I pulled some sort of fibs off this, high-low, you know, essentially 2 points, it's probably some sort of fib right here too. So if I put in this high, put in this low, probably somewhere around some sort of 38 retrace on this move too. So when you have lots of areas of confluence, it is just a much, much more powerful zone. Why do you look at this on a long-term time frame? Because most people that are trading big chunk portfolios are trading on longer-term charts, daily and weeklies, in some cases monthly for maybe the bigger portfolio stuff. They're looking at all three of those, daily, weekly, monthly. They may drill down into a 4-hour, right? Or some smaller time frame like an hour. Most of that is just for intraday trading purposes. There'll be all kinds of, but you can trade successfully, in my opinion, based upon using smaller time frames or windows of where this all took place. So if you don't feel like screwing around with this, you could just use one of those algos, one of the algos that Auvoria offers. So I know that variables, since Dasan and I are probably closer than any of the developers, variable's been off for a couple of weeks. So by the way, I think in the next iteration of that pause button's going to be on all the time. So just make it easier to pause the software if necessary. Take a look at the GBP US. Probably readjust these. So if you look at this, what are we seeing as well, right? See how it was rejected off that value area low. Imagine that. Hey, Steve, does this stuff really work long term? Why, yes, it does. Now, there's other factors here, too, especially this moving average adding to your arsenal of confluence. Moving averages line up where your other areas line up, certainly market profile or auction market theory stuff. Remember, that can also be on time and volume. What you don't see on these charts is time-based profile. That's a bit of more of a sophisticated indicator I have on other trading system charts, and just for the ease of keeping the discussion, broad and easy to understand, which a lot of the way I explain it isn't. I get that. It's probably my biggest fault. But just by the, showing up in these different podcasts, I can promise you by osmosis, it will begin to sink in over a period of time. All right. What else do I want to address? I don't really want to get too much deeper into that because I don't trade the yen. I don't trade anything in Aussie land. Doesn't mean you guys shouldn't, but I don't. So my insight into the yen is typically skipped over. Bitcoin, I think we're frozen in time. At least until the next shoe drops, right? I have like zero. I mean, you guys want to go back and see all the stuff I talked about with crypto. I basically said get out at the high. Here's spot gold. By the way, it's beginning to wake up again, but this is one of those weekly trends. If you want to cut out the noise of daily, right? Here's the noise of daily. Quite frankly, I don't think you get to see the whole picture, but weekly you do. I usually will expand this out to show the entire range of the zone, right? So you can sort of see. This is ideally what you want to do on a weekly chart if you're looking to enter into a position in something like this asset class. Now you notice with spot, unlike GLD, there's no market profile, right? Excellent market profile to be had just looking at the biggest ETF that trades this, which is arguably the GLD. Look how powerful the top of this has been capped off by not only the zone indicators, but also by the value area high in terms of volume. Anytime we've gotten up to this level, certainly here again, right? Anytime we've gotten above it, it's been an absolute sell. Again, here. So over 3 years, we've hit this point. Every time we've gotten up against it, it's been a sell. The problem that you run now is that we are real long in the tooth on this as a area to sell, right? So this, I can tell you, there's a bunch of long-termers out this. I don't think it's just retail traders. I think it's institutional as well, that are hovering stops up here. I mean, I know they're out there. I know there's just a fat pocket of stops up in this area, or the corresponding miners that comprise some of the other ETFs in the gold sector. Either way, it would not surprise me to have a absolute Q clearing event take place once we got above this. So if you're looking to short this at some point, you'd want to see what we do right here. And hopefully it's not what's called initiative activity, meaning that other time frame players are stepping in on an actual breakout to take this particular asset class up to a new level, because that's not something you want to short, right? You want to be against. It's one of the few times I talk about stepping in front of the train because it may stop right at the station, right? But it's difficult for it's a lot easier to see, in my opinion, in futures markets, but it's very difficult for the common trader to understand that when something's breaking out, whether or not it's doing it via initiative activity, or if it's just a Q clearing event, it's going to fall back down inside its previous range, right? The key to that is look at the volume, right? Or maybe go into the futures market space and take a look at the underlying futures contract and what's it doing. If there's a lot of initiative type of activity, like we're taking it up out of a range, this is upside or downside. You want to look at where that volume is accumulating. I mean, if there's just tons of, we pull back to that line and then just tons of buy orders come back in and start us to bust us out again, for at least, the current time, that's initiative activity. If it's a stock that's actually breaking out, I know it's very difficult to find a stock that's making new highs, but I'm pretty sure Shockwave will be in this arena at some point. If you don't know who Shockwave Medical is, it's something I've bought a long time ago, 20, back around $55 a share. These guys make a really innovative technology. It's probably going to gain some serious steam at some point. They basically put this wave into your arteries, and unlike past procedures, the wave turns all of the arterial sclerosis into a crust. It basically just flakes off the walls and gets absorbed into the bloodstream. It's pretty slick. So it removes blockages of the heart, not via drugs, but via a technology that shocks it. It turns it into almost like a dried up lake bed. Pretty slick stuff. And, I obviously sound like I'm talking my book here, obviously, because I kind of am. But in this case, I think the stock could just be a monster. I mean, we're talking like intuitive surgical monster, which is the biggest monster I've ever bought, to make the Da Vinci robot. Any case, when there's breakouts like right here, right? So this was arguably a sloppy but slightly productive cup and handle breakout. Yes, this is a weekly chart. This was the time to get in, right? And you want to see, as these things come back down to these areas, do they hold? And if they do hold from the breakout, it's a buy again. See how this dipped under this last week. Actually, let's go back to the day. This dipped under this area last week and it was bought up pretty heavily, trying to get back into that range, right? Notice this was also, as far as Shockwave's concerned, for the upper zone, that was the value area low as well. See that? Whenever something's in an upper zone as far as market profile, you always want to, you could include this data down here too, but I'm including just before its breakdown, but you could slide it back just like I did here and just include volume data only, right, on what executed in this upper zone, right? We're still down near a value area low. Doesn't mean it's a buy point. It's just giving you indicators, right? Stock's been much higher, but they had an absolute rip on their earnings report, which is good. And then they guided lower because of all the craziness that's going on and people focusing on other stuff in medical, right? But for the most part, you have the ability to break out of something, and to really how it reacts when it comes back to that break point tells you a lot about the types of players that are playing in this arena, right? Other time frame players called OTF or OTP, whatever you want to call it. You just want to be aware of that. That is my presentation today on acting and being like a institutional portfolio manager, because it really is about that. So from research process all the way down to seeing what's going on. I didn't get into the stock screener part. I've actually done I forget what week it was, but if you go back, you can actually see, I think it was October of last year. I did a whole Saturday preview on a really good stock screener I use on Investors Business Daily's website. So that being said, I wish everybody a great weekend. And as always, position sizing and risk management, doing your own research and not blindly following others, will significantly increase your chances for high win rates, regardless of your prep in other areas. If you have a bot creating this for you, and then maybe it's a Lux algo giving you signals. They're incorporating an absolute ton of factors, but use your own knowledge and have that be your confirmation, and then you will truly increase win rates. With that being said, hope everybody has a great 2023. I will see everybody on Tuesday.